All right, everybody, it's Sunday. And you know what happens on Sunday? VC Sunday School.
That's right. And as the months go on, the topics are getting more and more, I don't know, they're high level to me. We're talking about venture
Granular,
debt today.
granular.
They're granular. Exactly. And I'm like encountering companies with different issues, including whether to take on debt in various forms. And it just so happens that once again, venture debt is in the news as we enter a downturn. So we have a nice conversation about when and if and whether startups should take venture debt and whether you should trust the one who wants to issue it to you.
Of course. And we have This Week in Climate, we have this great startup that's working on synthetic biology, working to use agricultural waste to replace single-use plastics and paper, like the things wrapped around, like those Tide Pods or, plastics wrapped around your vegetables or meats from the supermarket. What a great interview this is, Molly.
It's so interesting. Idea. You're going to love it. I love these science founders. It's fascinating. It's going to be a great show.
All right, so stick with us.
This Week in Startups is brought to you by Harmonic. Need to speed up your growth without speeding up your burn? Harmonic gives investment, sourcing, and sales teams data superpowers. Learn how A16Z, Craft, Notion, Brex, and many more source better leads and qualify them faster. Get $4,000 off at harmonic.ai/twist. MicroAcquire, the startup acquisition marketplace. Start the right acquisition conversations at your own pace. Get free and instant access to over 100,000 trusted buyers with total anonymity. Say goodbye to brokers and meet your ideal buyer today. Go to try.microacquire.com/twist. And Revelo. Looking to affordably scale your product development with global tech talent in U.S. time zones? Hire vetted remote developers in Latin America with Revelo. Get 20% off for the first 3 months at revelo.com/twist.
All right, everybody, welcome to Sunday. Molly is quickly getting to her first year as a venture capitalist. And I knew this question would come up at some point because I got to answer this question an awful lot. It's around debt for startups. So I'm not sure how you came up with this question, if it came up with one of our founders, but ask away.
Well, it did. Both things happened. So I had a founder talk to me about trying to find a bank that would want to issue some debt to a startup. So that was part of that question. But then also there was a story in the Wall Street Journal today about startups filling funding gaps with debt, despite rising interest rates, was the headline. That as opposed to a down round, it sounds like some startups are raising venture debt instead. And then there was a story in Bloomberg about an Indian wealth manager, I think, raising a $361 million fund specifically focused on venture debt lending, $5 million to $15 million per company.
Yeah.
And then that got me wondering about what the heck with venture debt. And is that a sign of a down market? Is that a down market thing? So there's like a lot of mechanical questions in there. How does this work? When should you do it? What's happening now?
All right. You ever see the Wile E. Coyote, from the Warner Brothers Bugs Bunny series? And he's got the big barrel of gunpowder. And he's like going to blow up Bugs Bunny or something. And like there's a trail of gunpowder and like it's lit. And it's like he's running with the gunpowder. And it's eventually going to catch him and blow him up. That's kind of venture debt.
That answers that question.
Yeah. A lot of founders are like, oh, I can put $5 million in the bank. And most founders in the early stage are not going to qualify for anything close to that. But let's just put it at $2 million. My burn is $250 a month. That gives me 8 more months of runway. And I raised $4 million in venture. So I have 16 months. So I have 16 months plus this extra $2 million gives me another 18 months. Now I've got 24 months. Great. I got 24 months. And they're using it to extend their monthly burn. Now, the problem with this is if you don't have product market fit and you don't have a revenue stream, you've now just taken a loan out. You have this loan that has to be serviced and has to be serviced in a very short period of time. These are not 30-year mortgages. These are 5-year loans. These are ones where you pay debt for a year or two. The second you get the money, you start paying the interest payments. And then you have to pay the principal typically in a balloon payment in 3, 4, 5 years. The idea being some venture capitalist, you have product market fit, you can pay it down This is incredibly dangerous if the company does not have a path to profitability, does not have an existing revenue stream, does not have product market fit. And the people who most want venture debt are the people who don't have those things. When you have those things, a board will be sitting there with a company with 10 million in revenue. They've been offered 5 million in venture debt. And the CFO is like, okay, I've done this before. We have a $5 million line. I've negotiated it from 3 different people. I have no covenants. In other words, there's no rules that will turn the business upside down. And I can draw down, we're going to draw down 1 million. In other words, we have a $5 million essential line here. I'm taking down 1 million to start. We'll start paying interest on that. We'll keep it in our bank account. And we have the 4 million in case things go wrong. Of course, when things go wrong, sometimes this venture debt gets pulled because the market has collapsed. And so banks can do all kinds of crazy things. But man, if you start, you should not use this to cover burn, is my basic rule of thumb. And this is something you should not do until you have a CFO and a really tight accounting group that can predict when you're going to run out of money. Because as we've seen, Molly, many companies in our portfolio unnecessarily die or have down rounds or chaos and near-death experiences, both of those things, death and near-death, and then down rounds, because their accounting is so screwed up. And when the accounting is so screwed up, famously, there was a company, Zirtual, and Maren was on this program when we were investors, and she didn't have control of the accounting. This is all public. I'm not speaking out of school. I think she's a tremendous entrepreneur. I would invest in her again. But basically, the accountants, her outsourced accounting firm and her board was kind of asleep at the wheel. The accounting was not correct. She was not on top of it. She was a product person. Basically, she didn't know when she was going to run out of money. And then they told her, like, hey, we don't have money. And she's like, no, we have 8 weeks of money. And there was receivables and everything was a mess. So most entrepreneurs should not take venture debt. She didn't have venture debt. But the point is, most of the times companies die. They don't have good accounting controls. This is like somebody who doesn't know the rules of poker going and playing in a high stakes game. They're like, is a flush or a straight better? And you're like, did you really just buy in for $100,000 versus Phil Hellmuth and Phil Ivey and Daniel Negreanu in a poker match and you don't know the ranking of the hands? If you're not really good at accounting and projections and have a very tight business model and a path to profitability, do not go near this, please.
Yeah.
Too dangerous for you.
What about this idea that startups are taking on debt right now to avoid resetting their previous valuations? It sounds like 1,900 U.S. startups borrowed an estimated $22.4 billion through September 29th, according to PitchBook. And then not only are they taking on
what's
short-term...
What's the top number? 20 billion?
22 billion.
Okay, hold on. Keep going.
There is not only the risk of, do you have product market fit and are you default alive? There's also the risk of rising interest rates. So you might have this incredibly high, expensive debt on top of all of that. And maybe you're thinking it's non-dilutive, or like if a company came to us and we were in diligence, which is a bigger red flag, a down round or a bunch of venture debt at high interest rates?
This is a great question. And by the way, you said there were 1,900 companies who took on 22 billion?
Yes.
That's an average of $11 million in debt. I think that some of these might be very late stage companies that have like $500 million lines. And then there might be some people with very small ones, but let's put that aside. That's an incredible number. When a company comes to us and they have venture debt, this is where things can get really dicey. If you have debt, then the next venture capitalist, you better be incredibly strong performer for them to say, I'll invest 20 million and 7 million of my money is going to pay down that loan. And then you'll have 13 million in the bank. Because you start to get into what's called catching the knife territory. And it is possible to catch a falling knife by the handle or by the blunt side. But I don't recommend people tonight go to their kitchen, take out your knife block, the butcher block with all the knives in it. And then I'll encourage you to, just as a mental exercise, think about one person, your partner, dropping knives from 5 feet high and you standing there and trying to catch them at 3 feet. Anybody want to play that game? I don't.
Nope.
Because you're going to cut yourself at some point. It's not going to be fun. And you're going to ruin your knives, by the way.
You're going to lose a toe and ruin your knife tip.
Listen, Harmonic is a database that finds companies before any other provider and refreshes them daily. It's pretty amazing. It works really well for VCs who are trying to source those new startups and for B2B sales teams looking for new qualified customers, which is really important right now. For example, Brex, the startup corporate card, they use Harmonic to find newly incorporated founders to sell their product to, right? Talk about product market fit. And we love Harmonic here at Launch. Our investment team uses Harmonic to source and vet deals faster and more accurately. Because, hey, listen, they've done the work. They got all the data there. And we love to use the advanced search features to find information like, hey, a founder's background, their previous companies, if they've had any exits, how much money they've raised, and more. And we create perfectly customized searches that meet our investment criteria. Maybe we're looking for B2B. Maybe we're looking for marketplaces. Maybe we're looking for people who've raised a certain amount of money. And if you're watching the video that's playing right now, you see my team doing a really quick search for pre-seed and seed stage SaaS companies. These are critically important for us in terms of our bets as a venture firm. Get better data, make better decisions, and grow faster. You can do all of this at harmonic.ai/twist, and you'll get $4,000 off your company sourcing and monitoring product. That's harmonic.ai/twist for $4,000 off. What an amazing deal. Yeah, not a fun exercise. So this is a negative signal to answer your question. It's a big negative signal. And in a down market, it gets super dangerous. So again, now let's say you have raised $100 million. Let's say your company's making $30 million a year and you're losing 20. Got $100 million. You decide to put a $25 million venture debt on top of it. Now you got 125. You're losing $20 million a year. Okay, you got 6 years to figure this out. And you definitely have a CFO and a finance department. You got plenty of time to pay it down, et cetera. What happens is people have 3 months of runway and they're like, I need venture debt. Now, venture debt is not going to happen in that case, but I've watched this people with no product market fit, with 18 months of runway, decide to get obsessed with this. It's typically the founders who are obsessed with this at the early stage should be redirecting that obsession with their customers and their revenue and their product. They're focused on the wrong thing. It is a red flag for that reason.
Is it more or less then compare it to the down round? More or less because I sort of feel like if a company comes to, we're not going to be seeing companies that are taking a down round, right? Because we're early enough. Likely. But if you're a growth stage fund, we might. But I sort of feel like if a company came to us and they had raised a down round because the market, went from red hot to ice cold in a 6-month period, that to me would be less of a red flag than we took a bunch of venture debt to try to stay alive in a tough market.
I would
That's
say,
just like, the market slapped you upside the head.
Here's the thing. You can't take, if your company is truly troubled, you can't access venture debt. The venture debt issuers, they're very savvy. So it's kind of like in that situation, I don't think that situation would occur all too often. So if venture debt's given, it's given to people who can pay it back. There are some drive-by firms that might give this. And then what happens is you get into a really negative space where somebody like me, a venture capitalist, has to call the venture debt firm and say, listen, this company is struggling. I've made this phone call a half dozen times. I need you to push off payments for a year. You'll get 10,000 more shares of the company as warrants. But if not, the company's going out of business. They have no assets. Nobody's buying it. And then the founder's going to start a new company the next day. And I'm going to lose my $2 million. You're going to lose your $2 million. There's nothing here. We're going to back the founder again with a clean cap table. Right. That's kind of where these venture debt people then will play ball. If they know that they're going to get zero, they will become more flexible. But in a sale, I had a friend who sold a company and the venture debt had gotten upside down a bit. When he did this, $300 million sale, they said they wanted like 5% warrants or 7% warrants or something crazy. And he had no choice and wound up giving them like 3%. They wound up making $10 million in warrants on a $10 million venture debt line or something. So they can be quite aggressive and in a down market or be cutthroat. So it's dynamite. It's the wrong thing to do.
So when we see a story about Edelweiss Wealth Management backed by PAG looking to raise a $360 million venture debt fund to lend to new age or high growth companies in India, India's venture debt market apparently could surpass $1 billion this year, according to Stride Ventures. Are we thinking this is like some vulture behavior?
Could be vulture capital. It could be red flag territory. They could, in India and other regions, you could have a different framework of how the ecosystem works and a different expectation from founders. In some other markets, founders are not ruling the roost like they are here in America. Forget about founder friendly. It's even worse than it was in the early days of Silicon Valley, where founders were basically assumed to be replaced by professional management eventually. Over there, it could just be like, you're the founders of the company, you own 10%, the three of you have 3% each. We're taking over the company. And with debt, if you can't pay the debt, they can seize the company. So I don't know this firm. I don't know the Indian market all that much, but this is red flag territory for me because they they become senior. The debt providers become senior to all the investors, the venture capitalists, and obviously the venture capitalists are senior to all the founders and the employees. So what happens is basically the company gets seized. And that's where I think some of these people who do debt, they might be not this firm. I don't know them, but I don't know. But some of the debt folks could be looking to, if a company can't do it, extract max value, which could include seizing an asset which has great value. Be careful, founders.
Sharks are circling founders.
Yeah. When you sell shares and you have a board and you follow all the standard documents, standard terms, your chances of success go way up. When you start doing funky stuff and you start having a lot of debt and a lot of notes and different terms, it gets really complicated really quick. And then it freezes you out of capital markets down the road. Unless you've got a money printing machine and you can use money to pay down this debt and solve these problems, which most startups are just not going to be able to do.
There you have it. There you have it, everybody.
Be careful,
love
folks.
It. Absolutely love it. All right. Well, that's BC Sunday School. Next up, because it's Sunday, we have This Week in Climate Startups. And I have just another one of those super interesting, like super sciencey climate startup stories. We have Rob, the CEO and founder of Mi Terro, which is a synthetic biology and material science company that engineers upcycled agricultural waste. There's this whole waste to value chain thing happening now into basically like a plastic replacement. This is a really interesting company because they started out using spoiled milk to make t-shirts, literally using like dairy waste to make fabric, and then ended up pivoting, and they're in commercial production. This is not like an R&D stage company, making these biomaterials to replace single-use plastic and paper. And they're starting with those little laundry pods. There's like that weird little plastic around laundry pods. Amazing. That's now in baby food. It's like showing up in like the bloodstreams of babies because there's so many microplastics in the environment now.
It's not good.
So they're replacing that with agricultural waste. It's just it's super interesting. Really, really, really smart, thoughtful, genius founder.
I love this. I love this stuff. It feels like science can solve so many of these small issues, like literally small, small.
Micro.
And it just takes like thoughtfulness, right? Like this is like a tragedy of the commons. Like those pods are delightful to use. They've made life so wonderful to just drop a pod in your dishwasher. But man,
we don't think about the fact that they're literally encased in plastic that then gets flushed down the drain and into the ocean. Then we eat it in our fish. I mean, it's just like, so this is a total circular economy thing. Just take existing waste streams and turn it into that product and many more. Robert Luo is the CEO and founder of Mi Terro, coming up right now.
Enjoy the interview. Okay.
Enjoy.
MicroAcquire is a startup acquisition marketplace that cuts out everybody in the middle. Basically, that means they're going to help startups get acquired efficiently. If you're a founder looking to sell your startup, your project, your side hustle, well, you should know MicroAcquire is free, it's private, and there's nobody in the middle to screw it up. Trust me, I've seen so many times these brokers in the middle screw up a deal. You know why? Man, they might be looking out for the buyers more than the sellers because you sell your company once, maybe twice in a lifetime, but the buyers of companies might be buying 10 companies a year. It's the opposite of MicroAcquire. MicroAcquire has already helped hundreds of startups get acquired. This is such a great idea. I don't know why I didn't come up with this. And they facilitated hundreds of millions of dollars in closed deal volume. Their platform includes over 120,000 buyers. Now, these buyers have skin in the game because they pay $390 a year for access to the database and this marketplace of companies looking to sell. And these startups are all vetted. So if you have thousands of vetted startups currently listed for sale and 120,000 buyers, what's going to happen? Successful acquisitions. And the founders get free access and instant access to these 120,000 trusted buyers who, they pay for access. I pay for it, and I'm interested in buying some newsletters right now. And buyers like me can browse the listings for free. And the platform, of course, is totally free for sellers. Sign up for a premium $390 a year access to all the deal info at try.microacquire.com/twist. Once again, try.microacquire.com/twist. And if you want to list your company, go to the same URL.
Robert Luo is the CEO and founder of Mi Terro, and I am going to let him explain what this startup does because this is an amazing premise. Tell me what you guys are working on.
Absolutely, Molly. Thank you for having me today. we are solving a problem that happens every single day to everybody, but we don't talk enough about, which is microplastic.
Mhm.
Do you know that you and your family member might be drinking microplastic from the detergent and laundry pods that you use? Because
Oh.
these transparent flexible film are made from a synthetic plastic polymer called PVA, polyvinyl alcohol. When you wash it in your dishwasher, they break into microplastic that flows into the ocean and eventually will come back to the water we drink and the food we eat.
Mhm.
So it's a huge problem. 20 billion of these pods are produced in the US every single year, and 8,000 tons are just floating into the ocean. Our solution is to replace these microplastic from bio-based sourced biomass, and they can be made into biodegradable and water-soluble resins that are good for the environment and leaves no microplastic whatsoever.
So I would imagine before we get to the how, you're talking about replacing like all? Like how, what amount of things as I look around my daily life could be replaced with this new material?
We are starting off with these detergent laundry pods. Obviously, PVA
Oh, great.
is
That's the beachhead.
that's the
Mhm.
beachhead, and obviously PVA has been used in many other applications. For example, it can be used as paper coating and biter. It can use in textile. It can even use in our contact lenses that a lot of people wear every single day. They're also PVA inside.
Wow. Okay. This is the key here. I think people are going to find really fascinating. What is the biomaterial that you're using to create this new?
That's a very great question, and we're very honored and excited to introduce this new technology we had developed, and it's also patented. We are upcycling beer waste from beer manufacturers such as Anheuser-Busch InBev, and we are converting their beer waste into a bio-based polymer that can be made from the bacteria that we designed through fermentation. And after these bacteria create the polymer, we make them into resins, which you also see right here.
Mhm.
They look like thermoplastic resins, but they're made from bio waste. And then these resins, which I can also take it out, show you.
They're kind of beer. By the way, I love your props, and I love that you have Foley, like the sound is even coming through the microphone, and they're kind of beer colored.
Yes, we can make it transparent if needed, any color possible. And then these resins will then be used as a drop-in to the existing plastic equipment. Then our partners will make them into pods or other type of final products.
So how long did it take you to accomplish this feat? Like, this is serious science. This is hard science that you're talking about. Yeah.
Yes. We're developing different generation of our material. Gen 1 of our material was done in 2 years. And now we're developing Gen 2 of our technology.
And then which part, not super specifically, but which part is patent? Is it the designing the bacteria to sort of do this conversion?
There are essentially 3 parts of our technology. One is the extraction and purification of polymer from these agricultural waste. The second part is designing the bacteria. And then the third part is downstream processing, like fermentation, modification, and then make into final resins. So our technology covers all 3 parts.
And then how hard is it? You described sort of that the resins then become this textile effectively. Do you do that part also?
We
Or your
also
partners do that?
have the technology to do that. At the small quantity, we'll do it in-house. But when we scale up, we intend to license or outsource to existing infrastructures.
And is it specifically beer waste, or can it be other agricultural waste? Like how broad is your source of fuel?
Currently, we have trialed with beer waste and have done a success with it. We have also trialed with dairy waste, like whey permeate, which is the byproduct from ice cream, cheese, and yogurt production. We have also been trialing with other cellulose and lignin type of waste. And in the future, we are going to trial with plastic waste because we know there's a huge problem with plastic waste.
Right. How big a market you're starting with the pods, but I wonder I feel like people have no idea how widespread the use is of these pods in both dishwashers and laundry.
Yes. The entire application of for the PVA material that we try to replace has a commercial value of $25 billion as of today, which is massive.
So people are using that much. People are using the pods globally.
Not just pods. Pods, there are, or just in the US alone, 20 billions of pods are being produced. And US is not even the biggest using country in the world. The number one, I think, is EU. And then it comes US, and then comes Asia Pacific. So more and more people are using these pods and PVA derived materials.
So tell me about your journey to this point, because I know you've also gotten some press for using spoiled milk, the dairy products, and turning that into fabric, like clothing textiles. Is this a pivot for the company as the science has evolved?
Yes, the science has evolved and the business model has evolved. We did start off by creating textile fiber made from milk waste. In fact, the t-shirt I'm wearing right now is made from our own milk waste fiber.
Amazing.
Very comfortable, and we had some success with doing so. But in 2020, we decided to make a pivot to focus more on solving the microplastic issue, which we think is more urgent and has a bigger market to tackle.
And so that was really, in some ways, that was a mission decision. It sounds like it was a little bit of both, a business decision and a mission decision.
Yes, we actually decided to pivot toward this direction by a recommendation from our partner, because they were looking for a solution to replace the PVA and microplastic in their supply chain. And we thought our technology can be suitable for them at some degree. So that's when we started working with Unilever and Anheuser-Busch InBev to formulate this solution.
And how much kind of infrastructure do you have to create in order to capture this waste material? Like, do you co-locate with beer brewing facilities?
Ideally, we do want to co-locate or use their existing infrastructure, the fermenter and bioreactor where we grow the bacteria. So this can be done on site in their facilities before it delivers to the next partners we have that makes the resins and the final film.
Gotcha. And so what stage are you at now? Are you bench scale mostly?
We are capable of producing 10 tons annually. So it's quite a pretty big for a
so not
pilot.
Bench scale.
So we do have a production line. We call it a pilot production line that can produce the 10 tons of resins every single year.
Oh, that's amazing. And you have customers? You have paying customers who are buying this resin and using it already?
Yes, we do. We have customers in the US, in EU, and in Japan.
Incredible. And then tell me about your fundraising history. You raised $1.5 million at a $10 million valuation. That's it?
That was our seed round. We do have a bridge round that is going on right now. And we do have partners that want to jump in, but I couldn't disclose their name yet.
Of course. Yes, totally. Congratulations. That's a lot of success with something that sounds very capital intensive with not very much money. Is there also non-dilutive funding in there, or are you just really, really good at?
So we did receive $300K in non-dilutive funding, and we are applying for more grants like SBIR and SF.
Yeah.
But conception that biomaterial requires a lot of heavy investment.
Yeah.
I would say to some degree it does. And for the companies that are pioneers in the space, they launched about a decade ago. At that time, they required a lot of investment into bioreactors, building their own infrastructure. But the time has changed, and the government is fully behind biomanufacturing and biotechnology. In fact, the Biden administration just proposed a $2 billion investment into this space. So we do not have to build our own facilities anymore. Our technology relies on the existing infrastructure, so we can apply directly to what they have. That means we have a low capex to consider when we scale up.
That is fascinating. I would not have thought that, and I'm so glad you're right. That misconception definitely exists. Yeah.
One fact that you need to know about startups: finding engineers is super time consuming and super expensive. It's the biggest pain in the neck in startups. I would say raising money is easier than finding great developers. Well, if you're looking for qualified international developers without the crazy time differences, or if you just want to scale without sacrificing on quality, well, Revelo is the answer. Revelo is a talent platform that matches you and your startup with vetted full-time remote developers in Latin America. They work in the same time zone as you in the United States. Plus, it's more cost-effective than hiring in the US, obviously. And you'll get matched with vetted candidates within 3 days. This lets you hire internationally so quickly and so easily. Revelo's engineers are, of course, full-time, and they're embedded in your team. Just like normal employees, they're proficient in all the things that you probably have in your stack, whether it's AWS, Rust, Ruby, React, Python, Node.js, and more. Revelo's customers wait for it. GitHub, Foursquare, Carta, Indiegogo, Kickstarter. I mean, this is a who's who of successful companies. So go to revelo.com/twist and mention twist to get 20% off your first 3 months. Plus, they offer a 100% risk-free 14-day trial period. If you're not satisfied, you pay nothing. So head to revelo.com/twist and mention twist to get that 20% off.
How do you, given that amount of investment and the kind of relatively low CapEx needed to get into this business, how do you think about competition? I've certainly talked to a lot of companies who are trying to use various types of bio waste, and get sort of waste to value in some way. Is there going to be a fight for this beer waste in the future?
We look at this problem in 3 ways. And in order for us to protect our business and technology, we have filed patents. That's one way of protecting our technology. Second is to build a very strong supply chain relationship. I think for any type of B2B business, supply chain partnership is very important. Once we are in the door of Anheuser-Busch InBev and Unilever, it is very difficult for a similar company to kick us out and replace us. And the third way will be to execution. So time is money. We all know that. And speed is what determines the scalability and success of a company. And I know that right now, beer waste has been used in majority 2 ways. In some regions where they can use as animal feedstock, they will sell it for a small price. But in other regions where they can't, it's still treated as landfill.
You are, and this is evidenced by the way that you're talking about your business, a 3-time entrepreneur. What were your other companies and how did they lead you here?
I come from an unconventional, I would say, entrepreneurial journey. The first 2 companies were both software companies, whereas Mi Terro is a very deep tech synthetic biology and advanced material company. It was a fresh start when I first launched Mi Terro.
What fresh start in climate, fresh start in hard tech, fresh start in all of that? Or did you have an interest in climate solutions previously?
Yes, I have always been interested in climate solution. In fact, my second company, even though it was a software app, we developed a mechanism where we calculated people's outdoor activities from running, biking, basically things you don't do to drive cars. We will give you credit, and this credit will exchange for discounts around university campus. That was my first way of testing out the climate tech space.
And then how about the hard science part of it? Do you have a science background? How did you come to that expertise?
I was not trained as a scientist, so I had to spend a lot of time to recruit our scientists, engineers, and definitely learn a lot through the process.
Talk to me about this sort of the future for your company specifically. Like when you think about the addressable market now, you've obviously defined it. How many more plastics could you replace?
Yes. Our goal is to produce 100,000 tons by 2030, and that will make us the 6th largest PVA manufacturer in the world. The first 5 are in China and in Japan. There's none in the US, which also makes us the largest PVA alternative in the US and in the world, which would be very fascinating. But beyond that, we think we can definitely do more than replacing PVA and microplastic. We're also very interested going back into textile to help the textile industry make a change, because textile has a very long supply chain. There's the raw material, there is the additive reagent that's involved to bind the fiber together. So there are a lot we can do for our solution.
And it's really destructive. I mean, nobody thinks about cotton as being like a plant.
Right. Correct.
Right. I'm so curious about how you arrived to the point that you are. So you're producing in the tons already. You have paying customers. I mean, is the biology part of this, the bacteria part of this, de-risked from a science perspective already?
To some degree, we have figured out what type of bacteria and how we can design this bacteria to intake different type of biomass waste. Then we need to figure out the part where the downstream process was going to be like. How can we purify this to a high yield rate, which can help us to drop down the cost and provide a high quality product to our customer?
So yes, it is pretty de-risked, as in like if you want to expand this to other microplastics or other textiles, it won't be that much more science.
There will always be science for new R&Ds, but we have figured out a way that we can grow it fast and lower the cost.
How big do you think the waste to value market is? Like, this is definitely a growing part of this kind of, it's a version of circularity, I guess, right? In the climate space.
Absolutely. The waste to value market is growing tremendously year by year. We have seen companies that suck out CO2 emission from the air, make it into protein, make it into diamond. And we have also seen companies that are trying to leverage different type of biomass waste, turn into something that's valuable. It's at least to say that it's very important that these companies exist and create something that is truly sustainable and closed loop.
Yeah. And then how did you get connected with, it sounds like your connection to AB InBev and Budweiser was through Budweiser China?
So we were first connected through Budweiser China. We participated in a program, and then we got into further development when we got into the 100 Plus Accelerator, which was sponsored by AB InBev, Unilever, Colgate-Palmolive, and Coca-Cola. So four of the biggest consumer companies in the world.
Amazing. You're so calm about all this, but it seems like everything is really coming together for this business right now.
Slowly and surely. And this goes back to a phrase I love by Steve Jobs. It's not word by word, but he talks about you can never plan for the future. But when you look back, different dots will connect into line. And that's how I feel at our current stage.
And so in 5 years, you see yourself having replaced not just tons of PVAs and microplastics, but making a big dent in the textile industry and beyond?
We hope that we can make something more meaningful than what we're doing today. And textile will be one area, and contact lenses will be another area, because I too wear contact lenses. And for people that wear glasses, from time to time, we might wear contact lenses.
Yeah, contact lenses have microplastics in them. I mean, for crying out loud.
Yes, they do. They do. And they use PVA as a reagent to create the molding of these contact lenses. And these moldings are single use. So basically just use it, throw it away. Use it, throw it away. So it's a huge problem.
I feel like the longer I talk to you, the more huge problems I will uncover, but I'm happy knowing that you are tackling them. Robert Luo is the CEO and founder of Mi Terro. Congrats on all the success. Please keep us posted on what you're up to next.
Absolutely. Thank you, Molly, for having me today.
Amazing.